Within the music industry, live events didn't get spared from adverse impact of the pandemic. The consequences of cancelled or postponed concerts was that artists and tour musicians, support staff and all businesses around live events got hit very hardly. Importantly, paid subscription and the use of this subscription increased during Q1, during the height of the pandemic. Spotify reported 5% more subscriptions during Q1, and the interaction with the platform increased by 6% over that period.
Music royalties are very long-term assets. In the UK, for example, music royalty right lasts 70 years after the death of the last composer of a song.
The music industry saw its peak in revenues in 1999 at around $28 billion. That was when the main recording medium was still the compact disc. Then, over the coming 15 years, the total music revenues halved to about $14 billion in 2014. And the culprit behind that was clearly the development of the MP3 player, which enabled pirating. During these 15 years, the sharp fall in music revenues impacted music royalty prices, and in the secondary market, the price for music royalties dropped accordingly.
The changing factor in the music industry today is the trend how music is consumed.
To give you a sense of the magnitude of this consumer change, in 2011, streaming sales accounted for 4% of the total music revenues, but today, in 2020, that number is at 56% of the total sales of the music industry. Of the almost 8 billion people in the world, there are around 3.2 billion smartphone users, and of those 11% are paying streamers. Over the next 5 years, we expect the smartphone adoption rate to grow by about 7% per annum and the paid streamers by about 15% per annum. The penetration of paying streamers varies widely. In Sweden, where Spotify was invented, about 57% are paying music streamers. In the US, which is the largest music market in the world, the paying music streamers account for about 30%, and in contrast, in Japan, the second largest music market in the world, only about 9% are paying music streamers. One challenge is to normalize the cash flow projection, let's say from 5 years out, and therefore account correctly for the hype and drop of a hit, which happens typically during the first 5 to 6 years. Here we build on the music industry experience and proven expert knowledge of our partners. We see support coming from technology and big data. For example, there is a Swedish tech company that screens thousands of radio station and internet platforms in real time, and as such can provide fantastic data insight in the future. Today, streaming is already the major source of revenue of the music industry, accounting for 56% of the total of about 20 billion sales per annum. The second largest sales stream still comes from physical royalties, that is, CD sales or tapes or similar. Physical accounts for about 22% of the 20 billion annual sales, but is sharply declining. To put that in perspective, in 2000, the physical royalty revenues accounted for 97% of the total music industry income. The third important revenue stream is performance rights, which accounts for about 13% of the total music industry income. This is mainly driven by radio-generated income. While placing a song in a Super Bowl advertisement or a popular video game can quadruple the income of that particular song, overall synchronization accounts only for about 2% of the total music industry sales. From an investment perspective, we see music royalties as an alternative income investment that offers currently around 8% running yield. That said, there are a couple of very interesting tailwinds supporting music royalties over the coming 5 years. Firstly, there is the regulation change, which will uplift the composer's share by about 10% per annum over the next 3 years. Secondly, we expect music royalty streaming revenues to grow by about 15% per annum over the next coming 5 years.
And the way how songs are administered going forward will add an additional 5 to 10% to the music income stream.
COVID-19 was a real-life stress test for all asset classes. And during this period, music royalties as a whole have proven themselves as largely independent from the broader consumer behavior, and as such they were truly uncorrelated as an asset class. If one sums this all up, we see in fact an attractive asset class that has a running yield of around 8% that is likely to double its revenue stream within the next 5 years.